These days, most people invest primarily in ETFs, and for good reason. It works. You can earn solid returns with virtually no effort and relatively low risk. Of course, in theory, you could make more with active trading, but for most people, that doesn't end well. However, there are a few tricks you can use to optimize your ETF saving plans. In this video, we'll show you a very simple one that could even double your returns. Hello and welcome to another video here at Bloomberg Capital. My name is Henrik, and let's not keep you in suspense. I'll go straight ahead and reveal one of our tricks. Instead of investing throughout the entire year, you simply buy in early October and sell again at the end of June. So you're only in the market for 9 months of the year instead of the usual 12. Now, at first glance, that might not make a lot of sense, but I've prepared some numbers for you. First up, let's take a look at this graph here. Now, I've gone through and marked out in these green boxes here the periods of October to June, and then here you have these gaps, which are the months July, August, and September. And especially in the last years, we've seen a pretty clear trend, where in the green box, we saw a pretty significant rise, while in the gaps in between, we saw a decline or maybe a sideways phase. And this same pattern holds true for the last 3 years and even decades. And we've taken a specific look at the last 15 years or the time since the great financial crisis. And going all the way back, we see the same pattern holding up, starting all the way back here. But let's put this in specific numbers. So the prices are here on the left if you're interested, but the really important part are these numbers here. Because if we compare the performance when investing over 12 months of the year versus just 9 months of the year, we saw that in the last 5 years, with 12 months, you had a performance of 88.69%, which is certainly not bad. But if you chose to invest only 9 months of the year, you would have had a performance of 101.72%, which is a 13.03% increase. So pretty good. But the longer you go back, the more this effect accumulates. Because if you look at a 15-year period, then having your money in the market for these entire 15 years gives you a return of 449.23%. Also not bad, but if you simply exclude the months of July, August, and September from your investing, then all of a sudden this jumps up to 978.49%. So a 529.26% increase, meaning more than double the return on your investment. So you can see how easy it can be to optimize your ETF savings plan. Now, that doesn't necessarily mean you should always pull out all your money out of the market and reinvest it 3 months later, because you also have to consider things like taxes and fees. But if you know what you're doing, you could, for example, make larger ETF contributions in October, or maybe wait till the end of June before withdrawing money from your plans. The thing is though, in general, there are more and more of these kind of tricks, and they are becoming increasingly effective. But why is that? Well, to understand, we simply need to look at one dynamic of the stock market. Because a few decades ago, most people invested in the stock market through actively managed funds. And then came the realization that you could simply buy into the entire market with ETFs and get the same performance without these high fees. That worked well because ETFs tend to invest more heavily in high quality stocks, simply because they are higher priced and therefore higher weighted, which is true because these stocks were previously considered valuable by analysts. So ETFs in a way benefited from this analysis work without having to pay for it. And that made ETFs unbeatable. But now almost everyone invests in the stock market through ETFs, and there are fewer and fewer managed funds. As a result, most of the money is being invested blindly into the market. And on top of that, analysts now follow these ETFs because so much money flows into high quality stocks via those ETFs. So those stocks also rise the most because there's simply so much money piling in. So naturally, analysts mostly also invest in these. Now, this phenomenon has led to stocks like the US Magnificent 7 skyrocketing to extreme levels. And also, many ETFs are no longer as diversified as people might think. Because, for example, ETFs like the MSCI World, which is sort of the gold standard for diversification in the market, invests very heavily into the US market, and within that, mostly in the top stocks. So if money is blindly flowing into these top stocks constantly, without much scrutiny as to whether they're truly worth it, that might end badly one day. And we'll likely enter a phase where more actively managed funds regain the dominance again. We're not quite there yet, but over time, more and more tricks are emerging and will be emerging that you can use to your advantage. And it will certainly be more and more worthwhile to think about your investments. So if you want to discover more of these tricks or get advice on your investment strategy, feel free to join our free Discord. The link for that is found in the video description. And if you enjoyed the video, we'd also appreciate a like and a subscription. With that, I wish you a great week, and until next time, here at Bloomberg Capital.